This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi Stroud-Watts in Sydney. The top stories this hour. A cautious open ahead for Asia, with investors shunning risk as the fast-evolving trade war shows little signs of abating. Critical minerals, the latest sector in the tariff firing line, as President Trump challenges China to pick up the phone. Nvidia shares sliding in late trade after it reveals how new US restrictions on its chip exports to China will trigger more than $5 billion in charges. And we'll be live in Malaysia, where Chinese President Xi Jinping continues his Southeast Asia tour, seeking to shore up supply chains amid trade tensions with Washington.
Take a look at how U.S. futures are trading early in the Asia session. We are seeing the downside pressure after we saw stocks falling in the overnight session. We had a lot of volatility again overnight. We're talking about the VIX still above that 30 level. And of course, it's earnings season, so we were watching out for commentary related to the economic outlook and the prospects for the economy as we continue to see the back and forth on those tariffs around the world. But also, we were really listening to what bank CEOs were saying. We saw banks, the KBW index gain ground for a second session. We had Bank of America, Citigroup also surprising to the upside on equities trading. Of course, a very volatile market, especially when it comes to the treasuries market, right? And we heard from a treasury official now talking a potential rule change that could be applied, that could really change the market dynamics there in order to help the treasury market add capacity during really high volume times when there is market volatility. But take a look at what's moving in the after-hour session right now, because it was really the rising tensions and rivalry between Washington and Beijing that's being felt in the tech sector. And you can see Nvidia now losing more than 5.5% right now. We heard from the U.S. government that they told Nvidia that they would need permission in order to be exporting those H20 chips for the indefinite future, because they were worried that that could be diverted to a Chinese supercomputer. And remember, these H20 chips are supposed to be those explicitly designed by Nvidia to really work within the restrictions existing from the U.S. government, but to make the best GPU for China. So now we're expecting perhaps a $5.5 billion charge, according to Nvidia, when it comes to the fallout from those broader restrictions. And you can see the peers right now losing more than 3%, Heidi.
And those Asian peers are expected to be in focus today, Shery. You're absolutely right. That focus when it comes to Nvidia, the downside that we've seen, is expected to be reflected in this Asian session. We're already seeing that tone of caution, aren't we, when it comes to futures here in Sydney, looking pretty flat at the moment. Chicago Nikkei futures also seeing some downside, and China will be in focus there as well, ahead of course, first quarter GDP data. Any sort of resilience is likely to almost be irrelevant, right, because we're looking to next quarter's data, the domestic activity data, to really show the impact of these tariffs. But in addition to tech and that Nvidia effect, we'll also be watching for the impact of the critical minerals probe as well, given that 70% of that supply comes from China. It could also affect some of those producers in Australia as well. So you add to that the lack of progress when it comes to these trade negotiations. It doesn't look like Beijing's sort of ceding any ground, and Europe is not making much progress as well. It is all looking quite muted in terms of that trading energy that we're expecting today. But let's bring in for more analysis our Bloomberg Executive Editor for Asian Markets, Paul Dobson. So we're kind of seeing this lull at the moment, and there doesn't seem to be much of a prospect for further progress when it comes to these talks with Europe, potentially with some of the Asian trading partners as well, and certainly no signs of that off-ramp for China.
No, good morning, Heidi. I would say that muted or lull is probably quite good right now, given the volatility that we've had over the last couple of weeks. Everybody either licking their wounds, taking their profits, happy to wait and see. We've got this 90-day window now for those trade negotiations. But I think what the market would like to see would be signs that a deal is possible and can be done quite quickly. So there's a lot of attention, particularly on Japan, headed to the US to start those talks, to see what kind of progress can be made and how quickly that can come through, or whether it's long and painful and drawn out and we'll run the risk of going towards the end of the 90-day window. We heard from Europe that they're not counting on getting any deal anytime particularly quickly. And meanwhile, as you said, as far as China's concerned, both sides seem pretty entrenched for this moment in time and looking for that opportunity. Where's the off-ramp? How do they come around a table and start talking? Probably China would like a deal. Probably China can see that Trump is a person that could get them a deal, but they don't want to be bullied into it. They don't want to be, slapped with all of these tariffs and forced into a corner. That's not the way the business typically would be done. And so you have this sort of situation where markets, have been on a very big roller coaster ride. Some have recouped a lot of the losses that we saw immediately in the aftermath of the tariffs, but there's a lot of scars still remaining in the market, both in the bond market, in the stocks, in those measures of implied volatility you were talking about as well, still hanging over us.
Yeah, let's talk a little bit about the bond markets, because really Treasury is rebounding, but only after we heard from an official talk about the potential rule change for banks. Tell us a little bit about why this supplementary leverage ratio, the SLR rule, is important.
Yeah, it's something that the market has had in place since after the global financial crisis, since 2014, something like that, where basically big banks need to hold additional capital against all of their assets, and that includes treasuries and doesn't give treasuries any favorable weighting, which means that from their perspective, in times of increased volatility in the government bond market, they're unable to step in as much as they might like in order to prevent that volatility. So when we saw that really big sell-off in treasuries over the past couple of weeks, had they felt able, they could have stepped in and stemmed some of those losses by taking more of the treasuries onto their balance sheet in the, belief that the market would settle down over time. They're not able to do that because they would need to hold additional capital against it as current rules stand. That was relaxed during COVID when we saw extreme volatility, and the banks are hoping that might happen again in order to, be able to sort of better manage those risks. So we heard some suggestions that could be a possibility from Faulkner overnight. The market has been hoping that this could be a possibility for a while already. Because of changes in the regulators, that could open the door to that. And it's important because at the moment, US government bonds do carry a higher risk premium than we previously have been used to. The term premium has been blowing out, and the difference between swap spreads, which indicates a little bit that sort of extra cost for holding treasuries, has grown increasingly sort of wide or negative in recent years. So the banks would see this as a good thing. A lot of people see it as a bad thing, as a way that, banks would get a bit of a free ride, and they're still making big profits and giving back a lot of money to shareholders. So remains to be seen whether there's the will to push through on this, but it would, all things being equal, increase appetite for treasuries and therefore insulate the market a little bit when we get those really big pockets of instability as we've seen in the past couple of weeks.
Bloomberg's executive editor for Asian markets, Paul Dobson, there with the latest on the Treasury space. We continue to see that perhaps demand for Treasuries, really that dynamic starting to shift. And this as President Trump is now calling on China to reach out to him to start negotiations on resolving their escalating trade fight. The latest comments from the White House came as Beijing ordered airlines not to take further deliveries of Boeing jets and U.S.-made airline parts.
I do have an additional statement that he just shared with me in the Oval Office. The ball is in China's court. China needs to make a deal with us. We don't have to make a deal with them. There's no difference between China and any other country, except they are much larger. And China wants what we have, what every country wants, what we have, the American consumer. Or to put it another way, they need our money.
For more, let's bring in Washington, D.C. reporter Kate Sullivan. Kate, we have seen Beijing really stand firm and be pretty defiant when it comes to these trade negotiations that, of course, have not even started at high level. So what can we expect President Trump to do while all of this is happening, given that, of course, his consumers in the U.S. are expected to take a hit if these tariffs actually lead to higher prices?
That's right. And, we're not seeing any end in sight at the moment for this escalating trade war. As you saw in that clip, Caroline Leavitt, the White House keeps saying China needs to make a deal with us. We don't have to make a deal with them. So we're seeing, the U.S. and China really continue to dig in their heels on this. And the trade barriers we're seeing right now are at absolutely staggering levels. The U.S. has imposed a 145% tariff on Chinese goods. China has imposed a 125% tariff on all U.S. goods. It will be interesting to see how Trump responds to the collateral damage that we saw today, which is what you mentioned, China ordering its airlines not to take further deliveries of Boeing jets. This decision was made after the 125% tariff, would have doubled the cost of U.S.-made aircraft and parts and just made it really impractical for them to accept these jets. So, you're seeing another major American company get caught in this fast-moving, escalating trade fight. But as of right now, the White House is really showing no signs at all of giving in and just continues to say that they are waiting for China's call.
US officials have also indicated that the bulk of US tariffs imposed on the EU will stay where they are. Are we getting the sense that the White House has kind of dug in on this position, or is there any kind of openness to negotiation? I guess when it comes to President Trump, there's always, an openness. It just depends on how good he sees that deal is.
That's exactly right. The White House's posture on this is we'll take any calls, we'll negotiate with anyone who wants to bring offers to us. They've been very clear that they want to hear everybody out. But when it comes to the EU, there has been very little progress made on these trade negotiations. And the EU trade chief met this week with Trump's Commerce Secretary and trade representative. And what we've heard from that meeting is that U.S. officials indicated that most of these tariffs on the EU would not be taken off. So they're saying that these 20% reciprocal tariffs, which have been reduced to 10% for 90 days, as well as the other tariffs targeting sectors like cars and metals, that they would not be removed outright. But as you mentioned, it feels like every day Trump is announcing some new exemption or carve out or reversal. So it definitely remains to be seen whether this will hold. I would also just note the EU is threatening to impose a set of counter tariffs, but they have also held off for the next for the 90-day pause. So we will see ultimately, how this plays out and how dug in the White House is on this.
And it seems President Trump now has its sights on critical minerals as well. What do we know?
That's right. So Trump today signed an executive order that launches an investigation into the need for tariffs on critical minerals. So the White House says that this is under the Trade Expansion Act of 1962, and that it's meant to evaluate the impact of these imports on America's security and resilience. I would say, this is actually very much in line with what Trump has been saying about the point of the tariffs overall. So yes, we've seen the tariffs be used as a short-term negotiation leverage tactic, but I do think it's rooted in a larger ideological framework that he has about, using them to create a more protectionist, domestically anchored economic model. And Trump has talked specifically a lot about protecting supply chains and the national security implications. So, the order today says that if the Commerce Secretary finds that critical mineral imports do threaten to impair national security, and Trump decides to impose the tariffs, that those tariffs would then take the place of the reciprocal tariffs on trading partners.
Bloomberg's Kate Sullivan there, and we do have some further reporting when it comes to the sort of US strategy with these tariff negotiations and how they're trying to use this to pressure other countries to limit their dealings with China. The Wall Street Journal reporting that the administration is planning to use these ongoing tariff negotiations to pressure other US trading partners to limit their dealings with China, according to people familiar with these conversations. The strategy here is to extract commitments from trading partners with the US to isolate the Chinese economy in exchange for reductions in trade and tariff barriers that are imposed. So an interesting strategy that we've been looking at quite a bit in terms of just trying to sort of tighten the noose by the White House over Beijing's economic growth. Well, Chinese President Xi Jinping is urging Malaysia to work with Beijing to protect supply chain stability. He's visiting the country on the second leg of his Southeast Asia tour. Bloomberg's Avril Hong is in Putrajaya with us, and Avril, a lot at stake for both leaders.
Absolutely. I think it's really difficult to overstate the importance of this visit. As you say, Malaysia is the second leg of this Southeast Asia tour, which is the first overseas trip for the Chinese president this year. And of course, when we first got wind of this visit was in late March. And at the time, it was kind of touted as a way for China to emphasize its clout in the ASEAN region. But of course, this was before April 2nd, Liberation Day, those tariff announcements. And since then, China has sort of had to kind of pivot this visit as a way to convince Southeast Asian leaders not to cut deals with Washington at Beijing's expense. And of course, this is also seen as a way for China to tout itself as a more stable partner compared to the US. For the Malaysian side, also similarly, a lot at stake. I mean, you look at how China is Malaysia's largest trading partner, and it has been for more than 15 years. Total value of trade between Malaysia and China has exceeded more than $100 billion just last year alone. So Malaysia, on its part, will have to find a way to keep friendly with Beijing and then not antagonize Trump as it tries to secure concessions, potentially negotiate for lower levies. It has certainly, amid all this, rolled out the red carpet for the Chinese president, who arrived in Kuala Lumpur, the capital, late yesterday, and there were road diversions, cordoned off, and a lot of congestion as well. And in terms of that warm welcome that we're seeing, we saw massive billboards as well on the way in from Kuala Lumpur with the face of the Chinese president emblazoned upon it, welcoming very warmly the leader. So you can just tell the sort of signals Malaysia has been sending. Now, I'm standing in Putrajaya, the administrative capital, and we are just outside the Sri Padana complex where the leaders of both sides will be meeting later today.
Yeah, thanks for that update. Bloomberg's Avril Hong, of course, following that state visit by President Xi. Coming up on the Asia trade, a closer look at potential U.S. tariffs on pharmaceutical imports with the Johns Hopkins Bloomberg School of Public Health. Hear why M&G Investments is still constructive on Asia's three biggest markets. Plus, we look ahead to China's first quarter GDP report with Oxford Economics. We have much more ahead. This is Bloomberg.
Nvidia shares fell sharply in extended trading after the company revealed that it faces new U.S. restrictions on chip exports to China, a change that will cost it billions of dollars. Bloomberg's Annabelle Drillers joins us now from Hong Kong. And Belle, we're expecting to see that sort of sympathetic reaction across Asia tech and chip makers as well. What do we know at this point?
Yeah, definitely. Just starting with the market reaction, I think if you take a look at Nvidia and after hours, and we're seeing a slump of around 6%, it just tells you how we're going to be watching those suppliers as well, like TSMC, for instance, Wistron, Advantes, SK Hynix. I mean, we can expect all of these to fall at the open as well. What's happened has been something to start the week. So the government, essentially, the White House informed Nvidia on Monday that the H20 is going to be requiring an export license or a license to export to China for an indefinite period to come. The company then had to make a regulatory filing, and so that came through on Tuesday. And now, of course, we're discussing it this morning on shows. But essentially, the H20 chip, this is important because it's a chip that Nvidia has created specifically to meet the export controls that are already in place on advanced technology to China. Now this brings this new technology into the fray. And so the concern from the White House and from the Trump administration is essentially the H20 is just too advanced, essentially. It can still be diverted or used to create some sort of supercomputer in China. That's the concern from officials. Nvidia, for its part, is saying there's going to be an impact from this, and they've actually warned, as you say, billions of dollars, actually $5.5 billion in charges is going to come during the first fiscal quarter alone.
And just another example how really no company, no country is really immune to these potential tariffs and just restrictions and any measure coming from the Trump administration, because we had just heard this week as well that Nvidia was going to produce more in the U.S. as well.
Yeah, and that's sort of been one of these things that we thought perhaps this could be something that would appease the Trump administration, this effort from Nvidia to sort of reshore some of its production. But essentially, we have also been reporting since January that the Trump administration could be looking at taking this sort of step. And so, again, it's just seen as technology, at least from the White House, it's just too risky for China. It's definitely going to have a material impact on the business, and our Bloomberg intelligence team has been writing about this as well. They're saying that, again, that $5.5 billion write-down, it means that Nvidia could end up missing out on up to $18 billion of revenue for the year. And it also says that tells us that maybe there's been a little bit of front-loading as well coming from Chinese consumers ahead of the anticipated US sanctions. But essentially, the magnitude of this, from at least the Bloomberg intelligence team side, does reinforce their view that buyers as well might have pulled forward their orders aggressively into early 2025. And if the restrictions persist, they're also saying that Nvidia's data center exposure to China could normalize to low to mid-single digits, and that would be similar going back to early 2024 levels. But as we said, that market reaction, you can see that Nvidia in after hours, and we will be watching the Asian supplies very closely this morning.
Bloomberg's Annabelle Jewelers there with the latest. We have more ahead on the Asia trade. This is Bloomberg.
Bank of America stock traders posted a record quarter with revenue rising 17% to almost $2.2 billion. It's also maintaining its forecast for quarterly net interest income of up to $15.7 billion by the end of this year. Meanwhile, Citigroup inched closer to a key profitability target in the first quarter. Its traders surpassed expectations with a record haul of $6 billion in revenue from its wealth and retail businesses. The CEOs of both banks say they're monitoring President Trump's policies and the potential impact on earnings.
Our research team, like many research teams led by Candace Browning, does not currently believe we'll see a recession in 2025. However, they've lowered their GDP growth rates for 2025 and continue to see no rate cuts during 25, but expect as inflation gets under control, you may see them in the future.
I am not going to try to predict the unpredictable. While our corporate and consumer clients are resilient and in good financial health, the world is in a wait-and-see mode and is facing a more negative macro outlook than anyone had anticipated at the beginning of the year. And we know that prolonged uncertainty generally hurts confidence.
And that negative macro outlook that Jane Fraser is talking about really reflected by investors' pessimism when it comes to the broader global economic outlook. Bank of America's monthly survey now saying that 82% of respondents expected the global economy to weaken. But what was interesting, though, was that pessimism wasn't necessarily fully reflected in their asset allocations, which could mean the potential for more losses in U.S. stocks. Of course, we have seen the seesaw ongoing when it comes to the markets in the last few weeks.
Yeah, and it's interesting. Clearly, bank executives, the ones that we've spoken to, are concerned about their views when it comes to recession risks in the U.S. economy. But that seems to be really a problem for later, right? If you take a look at these expectations, they're worried, but the first quarter results are not really going to reflect that. And we're sort of looking like the view is looking okay for now, but getting further levels of uncertainty as we head further into the year. The six biggest U.S. banks buying back roughly $22 billion of stock, adding a collective $1.2 billion to their loan loss reserves as well. So strong performances. Consumer spending at this point is holding up, even increasing in some areas. Profits and upwards of $40 billion for the quarter. But that sentiment, though, caution is very much the name of the game, citing that uncertainty, the unpredictability in the macro environment. Some of those banks have increased their loan loss reserves to prepare for a potential risk of downturns. This is Bloomberg.
You're watching the Asia trade. So President Trump is now calling on China to reach out to him for talks aimed at resolving the escalating trade fight. But a former top Chinese official says Beijing will only engage in talks with Washington if U.S. leaders show some respect. Former Chinese Vice Minister of Finance Zhu Guangyao spoke exclusively with Bloomberg on President Xi's 3 main principles for dealing with Washington.
I think for this specific negotiation should be based on real instruction by 2 presidents. President Xi highly emphasized the relation with the United States. President Xi always emphasized based on 3 principles: mutual respect, coexist, and win-win situation to develop a healthy, stable, and sustainable relationship with the United States. That's China's policy. That's President Xi gave clear instruction to all level of Chinese staffs. That's based on that. I was before to deal with U.S. in economic. We fully respect the U.S. We fully follow the instruction by President Xi Jinping. We do everything maintain the healthy, stable, and sustainable relation with the U.S. But this time, again, we must take action, retaliate, because we don't want the whole world return to the jungle of jungle law.
So just to be clear, right now, the 2 sides are not on speaking terms. Officials on 2 sides are not discussing possible solutions to the trade war. Is that correct?
That's subject to how do you define that. If that's U.S. want China totally accept the U.S. proposal, to accept U.S. conditionality, I think that's no negotiation. And must be under the mutual respect and with this joint win-win situation.
What does mutual respect look like? Would the U.S. have to reduce the tariffs to 85%, 60% to bring President Xi Jinping to negotiations?
I know in U.S. team always think the President Trump is the top negotiators. Art of Deal, the book written by President Trump, and let's do business. Now it's country-to-country relations. We should exactly follow the rule of WTO to deal with bilateral trade dispute rather than to use just pressure. Since People's Republic of China founded, China never yield to outside pressure. So that's why I hope real negotiation for trade imbalance issue should be based on mutual respect, not just use this pressure and let this other side accept all conditionality raised by U.S. That's impossible.
China's former Deputy Finance Minister Zhu Guangyao there speaking exclusively with our Inside anchor Haslinda Amin. Well, China Southern is suspending the sale of 10 used Boeing planes following the escalating trade war between the U.S. and China. Bloomberg's China correspondent Min Lo joins us now. So what do we know about the suspension? How does it impact Boeing and the broader aviation sector?
Yeah, just to give you a bit of context, this suspension comes after the Chinese government had asked its airlines to stop any further deliveries of Boeing aircrafts. And this comes after China had imposed 125% reciprocal tariffs on U.S. goods, which means that even without the instruction to halt from the Chinese government, the cost of these aircrafts would more than double under the new tariff regime, making it expensive for these airlines to acquire them. We understand from sources that the Chinese government is looking at ways to support some of these airlines that are going to be hard hit by the great higher cost. And China Southern is said to be suspending the sale of their used aircraft that they were planning to upgrade over fears that it might become more difficult for them to acquire new aircrafts from Boeing. Now, in terms of the immediate impact, some analysts say that Chinese airliners may be liable for penalties, although at this time, Boeing may not enforce them, just given the circumstances. In terms of immediate impact, impact because Chinese airlines are still operating at excess capacity given the kind of lower travel demand after the pandemic. There's not going to be an immediate operational impact, but it does show China's reliance on overseas aircrafts and parts because there are hundreds of these Boeing aircrafts in the Chinese fleet that will require maintenance and repair. Sources say that the leasing companies and Chinese airlines have accumulated enough of a buffer of parts to be able to tide through the short-term supply crunch. For Boeing, it's about 5% of their backlog order that belongs to U.S. orders, so to Chinese orders. So it's not going to be a huge impact in the short term, but longer term, China is forecast to make up about 20% of global aircraft demand. So it's going to be a big slice of the pie to miss out on.
And the thing is that this escalating trade tension will actually have an impact on both the U.S. and China as well, right? We are getting some economic numbers out of Beijing. What are we expecting?
Yeah, we're getting the March numbers, and actually it's looking to be quite robust. The first quarter GDP expected to come in at 5.2%, which is slower than the last quarter growth in 2024, but still pretty strong if you look at fixed asset investment, industrial production, both expected to remain steady, and retail sales actually expected to pick up to 4.3%. So a pretty strong first quarter that is expected to anchor China's full year's growth this year, because bear in mind the first quarter we expect to see shipments being front-loaded just ahead of the reciprocal tariffs because March is just before Liberation Day in April, right? So we have all these banks that are downgrading the forecast for China's full-year growth, and the first quarter growth is going to be very important to pull up the overall growth numbers. We also have property investment still looking to be very negative at about negative 10%. We have the home sales data expected to be out today. That's going to give us a sense of how far the housing sector has bottomed out, because last month we did see a big improvement in the home sales decline, narrowing from double-digit declines to just down 0.4%. So this month's number will give us a sense of whether that trend is sustainable.
Bloomberg's China correspondent Min Lo there with what to expect from those economic numbers out of Beijing today. Take a look at how we're setting up for the broader market opens. We're seeing the Japanese yen hold steady at that 143 level against the U.S. dollar. We continue to hear from analysts predicting that Japan will allow the yen to actually strengthen to help narrow the U.S. trade deficit as the U.S. and Japan now start trade negotiations. Not a lot of movement in the currency space right now, but the yen will be one of those that we'll be watching today. Tokyo preparing for those tariff negotiations with the U.S. on Thursday that will test whether President Trump is ready to make trade agreements with allies. Bloomberg opinion columnist Garode Reedy says that if Japan can't secure a good deal, there's really little hope for others. Garode joins us now. So really, given that Tokyo has been one of the strongest and closest allies to Washington for decades, Garode, what are you expecting from these talks?
Well, exactly. It's going to be a real canary in the coal mine, I think, for other countries, given that, if even Japan, one of the US's most critical security allies, obviously very important if the US is actually serious about looking to contain China. If even Japan is unable to secure a good deal, it's going to be very hard for the other countries, including the countries that have fought back, as the US has put it. Japan hasn't done anything of the sort. They've been very quick to say they want to go and negotiate, and indeed the negotiating team is heading there right now, or very shortly, I should say. In terms of what I'm looking at, really, it's what does the US side want? That's the real critical thing that we haven't seen here. The US side has spoken about the trade deficit. It's spoken about things like American auto sales and supposed tariffs that Japan imposes on rice. Is that just a negotiating stance, or what is it that the US actually wants Japan to do? And can Japan make the Trump administration understand what the actual reality on the ground is?
What are the next steps, right? Because we have really seen a narrative of some pushback from Japan, which I think has been quite interesting in terms of, they're not willing to really just put everything on the table. So what are the expectations for the next kind of part of the progress if we're seeing really muted progress at this point?
Yeah, the minister who is leading Japan's side of the negotiations, Ryosei Akazawa, he has said that what he wants is a win-win deal for both sides. Now, whether that is something that is realistic or something that can be secured, it's only 5 years since Japan and the US actually signed the last trade agreement that was brought up during the first Trump term. In terms of where they can go or what the next steps are, it's really going to have to see, what they can actually persuade, whether they can persuade the Trump administration really to see reality as it is. One of the main reasons, as I highlighted in my column today, one of the main reasons for the trade deficit with the US is that Japan sells a lot of cars in the US, and the US sells barely any cars here. And that's true, and the Trump administration has complained about that. Is there actually anything that can be done about that? I don't think there is anything that can be done about that in the short term, or even in the medium to long term, but simply because of Japanese consumers' preferences. So I think the first step will be to see for the Japanese side to sound out the US, see what they can actually get them to agree on. Perhaps they can make an agreement on sales of LNG from this planned LNG project in Alaska. Japan would be only too happy to buy more military equipment from the US. If the US wants the yen to be stronger and the dollar to be weaker, Japan would be perfectly fine with that. Now, whether that's actually something that can be engineered or not, that remains to be seen. So it really, I think the ball is very much in the US's court in terms of what do they actually want to get out of Japan.
All right. Check out Garode Reedy's column, Bloomberg opinion columnist Garode Reedy there with the latest on those views as Japan and the U.S. start those trade negotiations. We continue to see, of course, the market volatility around those tariff news. And we are now hearing from J.P. Morgan that they see Japanese companies forecasting perhaps profit declines in fiscal 2025 compared with the previous year, given these risks around U.S. tariffs. And with the market volatility, we continue to watch the super long yield premiums in Japan, and the JGB markets hit the highest since 2002. In fact, we're talking about the 30-year bonds, the premium that investors demand to hold those bonds over 5-year notes, for example, widening to the most in over 2 decades. And we actually saw JGBs plunge after that weak demand at a 20-year auction in the previous session as well. So we'll continue to watch the JGB space as we're watching the Treasury space very closely as well, given that really that demand dynamic for global bond markets seems to be shifting with really economic concerns rising. We have more ahead on the Asia trade. This is Bloomberg.
We'll have to see where it plays out. Nothing in our estimates right now assumes a pharmaceutical tariff, but we continue to monitor the situation and speak to the administration, who's engaged with us on a regular basis to get our thoughts and views on a number of items.
Johnson & Johnson CFO Joseph Wang speaking to Bloomberg. President Trump wanting Congress now to change a policy that gives certain drugs longer protection from drug price negotiations in Medicare. Trump has directed his health secretary to work with lawmakers to end the differential treatment for small molecule drugs, typically pills and biologic medications. The directive came in an executive order that Trump signed at the White House, which aims to improve on the policies enacted by the Biden administration. And we're seeing now this White House push to lower drug prices, as experts are also warning that Americans can end up paying more for medicines as a result of Trump's sweeping tariffs. And of course, we now know that the president has also initiated probes into the impact of pharmaceutical imports on U.S. national security. We'll be watching those pharma stocks here across Asia as well that have, of course, global links everywhere. Our next guest actually says the U.S. relies on a global network of manufacturers for its prescription prescription drug supply. For a closer look at the implications of drug-targeted tariffs, joining us now is Mariana Socal, Associate Professor at Johns Hopkins Bloomberg School of Public Health. Mariana, good to have you with us. I guess the bottom line is, and the most important question would be, will Americans really be facing higher drug costs, not to mention perhaps shortages of more critical drugs as well because of these supply disruptions and potential tariffs on pharmaceuticals themselves?
Thanks for having me. Excellent question. The U.S. already pays much higher prices than every other nation in the world for the same drugs. There are estimates that the U.S. pays on average 3 to 4 higher prices for the same branded products as compared to other industrialized countries. And these higher prices, they do have a direct impact on the health of Americans. For several years, the data has shown the same levels. It's about 1 in 4 adult Americans who has reported to not have been able to afford the prescription drugs that they needed because of the cost. So there are implications already from the high cost of prescription drugs in the American market. And that's why historically drugs have been exempted from tariffs. There is this understanding that healthcare costs are very high and prescription drugs in particular have very high prices. And so far, there has been a protection of branded products and generic products from tariffs in order to protect those prices.
Which is one reason why the White House actually wants to shift some of that production domestically as well. And they're looking into these pharmaceutical imports, right? But doing this and perhaps leading to tariffs, would that help?
Well, the U.S., like you mentioned, we do rely on imports for prescription drug supply. For generic products, which are not protected by a patent, the global network of manufacturers is far and wide. And manufacturers for branded products, they hold the patents, so they can produce the drug wherever they prefer, and there is no competition. So I would say that the key word here is competition. If tariffs are enacted, branded products, because they do not have competition, they can more safely pass on the price because they own monopoly over those drugs. Now, the question is whether or not they will relocate. That depends on the certainty and the expectations about, where will the biggest markets be, how much relocating will cost, how much higher the cost of the products will be, and cost of producing in U.S. soil. So there are many unanswered questions right now, and especially the possibility that other countries will place tariffs on U.S.-made products. So all these questions remain unanswered, and they will, for sure, be impactful on manufacturers' decisions to relocate. For generic products, which are not protected by a patent, manufacturers can be anywhere in the world. So there is strong price competition, and American manufacturers would have to very carefully think through that competition when thinking about relocating as well. It is very likely that generic drugs, because they are so low cost and very low profit margins, it's likely that absorbing costs of relocating, the higher production costs from being in the U.S. soil, and all of these costs, is likely that global prices will still be more competitive.
This is all happening at a time where we're also seeing other seismic shifts and changes when it comes to federal healthcare, right? For example, the mass layoffs that we're seeing that could potentially affect new drug approvals. Is that also a risk in terms of the pipeline of new drugs and medications?
Well, I guess certainty is a very important word for pharmaceutical manufacturers. They must plan their research and development strategies many, many, many years in advance. And so the typical drug development takes more than 10 years between initial drug discovery and final product coming into market. So these questions that we're facing right now, they will surely impact decision-making for years to come. And the most certainty we can have, the most impacts we can expect in the market, the better these forecasts can become. But right now, with very few certainties, it becomes very problematic for manufacturers to make these decisions without a lot of information.
We've also seen President Trump actually in the last few hours signing the executive order, which is aimed at giving small molecule drugs a little bit more protection in terms of negotiations on pricing with Medicare. What is the sort of uptake of this and the impact of this, and does that give, better prospects of affordability and pricing?
Right. I think the Medicare negotiation program, it targets a very selected group of drugs. And they are drugs that have been in the U.S. market for a long period of time without the entry of competition. The U.S. market is very unique in the world that it really depends on competition in the form of generics and biosimilars products to enter the market and then lower prices. For small molecule, for these conventional products that are not biologics, the Medicare drug negotiation program could only select drugs that have been in the U.S. market for at least 9 years without a generic competitor. So that if that period of time is extended, what will happen is that manufacturers will have a longer period of monopoly in the U.S. market. And that can, on the one hand, help prices stay up, because without the entry of generic competition, then prices will not go down. On the other hand, that will incentivize manufacturers to invest more on new products, because if they can anticipate that their monopoly periods may be longer, then there will be more time for rewards, for capturing rewards in this market. So it's a trade-off, and it's important for all of us to see where this will lead.
Mariana, Socal, good to have you with us, Associate Professor at Johns Hopkins Bloomberg School of Public Health. The school is supported by Michael Bloomberg, the founder of our parent company, Bloomberg LP and Bloomberg Philanthropies. And we do have breaking news out of Japan. We are getting the core machine orders now, gains of 4.3% for the month of February, month on month, and really reversing 2 months of losses and also beating economists' expectations. When it comes to the year-on-year number, gains of 1.5% instead of a contraction, showing perhaps improving investment trends across the country. This is Bloomberg.
Take a look at what we're watching when it comes to gold. Of course, this has been really quite a roller coaster ride for the precious metal, climbing now again to a record as is expanding. Really sort of consistently worsening trade war sparking that return to haven demand. We did see at one point in the sort of depths of the Treasury sell-off as well that we were starting to see that sell-off in gold, perhaps to cover some of the losses when it comes to equity losses as well. But at the moment, we're returning to that haven demand there, edging to that record high on Monday. The Trump administration pushing ahead with other probes that could broaden the US trade war, including now into the likes of critical minerals. We're also expecting more details on semiconductors, electronics as well. The other stock that we'll be watching as we get into the start of trading in Sydney is Rio Tinto, the major miner, the iron ore miner, seeing exports falling to a 6-year low due to the impact of tropical cyclones that disrupted exports from its Australian terminal. Full-year guidance has been maintained there, but it does expect exports to be on the lower end, despite prices having been pretty steady in recent months. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens after another volatile session on Wall Street overnight. We saw U.S. stocks pressured. We could see more pressure, especially for chip makers across the Asian session, Haidi, as we heard that Nvidia will now require a license to export its H20 chips to China, which had been specifically designed for that market to get around existing restrictions.
Yeah, interesting that even a behemoth like Nvidia, which has talked about moving more production to the US, is not unscathed by this widening trade war, right? And is that sort of expanding of the scope as well? In addition to the Nvidia reaction, we're watching some of these critical minerals companies as well, given that we know that that could be the next target in this expansion of Trump's trade war.
Yeah, and that escalating trade tension really being felt across assets, especially in the Japanese yen, which has been, to be fair, a little bit range-bound, given that we are now headed towards the Japan-U.S. trade negotiations. Some analysts saying that we could see potentially more strength for the yen in order to really tackle some of that trade deficit from Japan against the U.S. But you can see the Nikkei now steady, not doing much at the open. We'll be watching, as I said, those semiconductor makers. There you can see a little bit of upside. We're watching the super long yields because they've hit like new highs because we continue to see these concerns over the fiscal outlook, not to mention, of course, market volatility. We had JGBs plunging in the previous session because of a weak 20-year auction as well. Take a look at how Korea is coming online. SK Hynix, Samsung in focus, obviously. But at the same time, we had seen the Korean won now hit that 4-month high against the U.S. dollar. We'll be watching the 14.20 level at this point because we're seeing a little bit of pressure early in the session. The Kospi down 0.1%. Of course, we had seen that $8 billion supplementary budget being announced for in order to shore up the Korean economy, and we're headed towards that Bank of Korea decision on Thursday as well, Heidi.
Take a look, Shery, when it comes to how we're setting up for the Open here in Australia, looking pretty muted. And I suppose, in retrospect, muted, cautious is probably better than the levels of volatility that we've had. But certainly there is a sense dawning on these markets that this trade war, the deeply entrenched positioning when it comes to major trading areas like China as well as the EU, where not much progress has been made on these negotiations. There's no negotiations on foot with Beijing at the moment. It seems to be setting in as a reality for these markets. But take a look at just the first couple of minutes of that staggered session. Open here in Sydney, we're off by about 0.1%. We are watching, of course, some of the miners today, particularly when it comes to critical rare earth minerals as well. The Aussie dollar had, along with the Kiwi, gotten a little bit of respite from a bit more risk sentiment, looking a bit better. But at the moment, we're seeing some downwards trend again, 63.40, but it's clearly a better picture than under 60 that we were just a week or so ago. Also watching treasuries as well, because we have had some commentary in terms of whether the worst of bond market volatility has been over, but we're seeing at least a bit of calm that has followed the turmoil for now, Shery.
Our next guest says that he actually remains constructive on the 3 largest markets in Asia. Let's get more with Vikas Pershad, Asian Equities Portfolio Manager at M&G Investments. Vikas, I would understand when we're talking about Japan, when we're talking about India, for example, there's been still a lot of exuberance about these markets. But when it comes to China, the trade war seems to be escalating against the U.S. So why are you still optimistic?
It's a very fair question, given what's going on. I will say that when we saw the extreme market volatility of 2 weeks ago and the beginning of last week, the first 2 markets to which we did add more capital were India first, Japan second. In China, we have been fully deployed. We've been allocating more capital over the last couple of years. We have focused across sectors, as we've been talking about over our past few conversations. Domestic consumer companies, there we have allocated more capital. Some of these companies are going abroad. Where we have reduced our exposure, or we have just continued to stay on the sidelines in recent weeks, are some of these more sensitive sectors like semiconductors, like the FA, factory automation sectors, auto OEMs, auto parts. There we're taking a more cautious stance. So yes, in recent weeks we have evened out some of our constructive views and added more capital to Japan, but in more than that to to India also.
In China, when you say adding to some of those consumer names, is your expectation that the economic growth of China will not necessarily be materially impacted by these escalating trade tensions?
Well, even at an aggregate level, if they are impacted, what we've seen is even over the past couple of years, the domestic consumer companies, the F&B companies, the companies that are operating QSRs, eating into the share of Western companies, they've done very well in China, and now they're starting to go abroad. When I was here last time, we spoke a little bit about Mishui and our constructive view there, our involvement in that name, and that's a name, and that sector is one where we continue to evaluate opportunities, allocate capital, similar names to that one. And so there are plenty of investment themes in China that match our time horizon, that should match long-term investors' time horizons as well. Yes, there's a lot of volatility now. We go back a couple months, actually, if you just go back over the last 7 months, and you think about September, the excitement that happened then, that faded a little bit. Then we had the DeepSeek moment at the start of this year. The tech sector is a little bit trickier. Although there are, when we look at the tech sector in China also, there are read-throughs for Japan and Korea that make us cautious on those markets as well. So even though we've been adding more capital to North Asia, and in South Korea and Japan in particular, it's not the same sectors where we might have been adding in previous sessions of market volatility.
What are you adding for Japan? Because, you know, there are signs that there may not be that much progress when it comes to trade negotiations. There are concerns about the strengthening yen and the impact on exporters. And of course, there's, you know, broader sector concerns like auto tariffs as well. So what are you constructive on when it comes to Japanese opportunities?
Well, we are being very stock specific. We're trying not to be thematic. We're not trying not to let the headlines dominate our capital allocation decisions. Where we are not allocating more capital yet is in the automotive sector, auto parts. We can continue to maintain our positioning there. The extreme price action of early last week did help us make the decision to add more to financial companies. That includes some of the banks, that includes some of the insurance companies. That was made easier by the magnitude of the moves. Now, elsewhere, the capital that we've been allocating is to some of the domestic companies, the consumer companies. Also, in Japan, there's a wide swath of factory automation companies, and when we look at the data, we presume that the March quarter will be challenging. The June quarter will be even tougher. The orders data will be quite poor, we presume. So historically, when we've seen periods of volatility, these economically sensitive stocks have sold off very aggressively, and we've become more assertive in our positioning there. This time, we're not doing that. So it's a narrow group of companies. We're very focused on stock-specific stories, fundamentals. We've also widened out the valuation ranges that we're putting, given that there is uncertainty increasing when it comes to earnings for the next few quarters, not just the very near term.
Where do you see the opportunity when it comes to India, right? Because there was a lot of concern that perhaps we hadn't quite bottomed out for India stocks. Valuations are always a concern when it comes to this market. But since this trade war, and I guess since we have the perspective of a relatively light touch on tariffs from the US to India, it seems like global funds are returning to India as potentially some sort of haven.
I think that's a fair call. We have done the same. We have increased our capital allocation to India over the past 3 weeks, some in anticipation of the tariffs and more after that. What has helped India as a starting point is that we're coming off the all-time highs from late September. So for a period of 5 months, till the end of February, beginning of March, the markets sold off broadly across sectors, almost indiscriminately, and in the small and mid-cap space in particular. As we've talked about in the past, India is the best performing market in the world for small and mid-cap companies, for multi-baggers. So early March became a very good starting point, and in March, India was the best performing market in the region. It was, as Bloomberg was highlighting yesterday, the first market to erase the post-tariff losses. And it seems that, as you highlighted, there's no market that is immune to the to the tariff noise, but some markets are more inoculated than others, and India seems to be one of those. We have allocated more capital to domestic companies and also some of the exporters as well. They should benefit from the China Plus One strategy. There's the CDMOs, some of the pharma companies that are domestically focused, the hospital sector, diagnostics, and then there's a lot of domestically focused companies as well. Fabiana was on recently. One stat she highlighted, I believe, is that in the U.S., less than 40% or more than 40% of revenues for the S&P 500 now come from outside the U.S. In India, the trend is the opposite. In the U.S., it's 40% plus and rising. In India, it's less than 30% and falling because the domestic growth rate is so high. So well over 70% of revenues now for the 200 largest companies in the listed space now come from India. And that underscores the appeal of that market amidst the noise globally.
Vikas Pershad, Asian equities portfolio manager at M&G Investments, as he talks about that noise. Of course, we continue to hear it around the semiconductor space today. Take a look at how SK Hynix trading down more than 2%. IBM also, Samsung also down. You're seeing a sea of red after we heard that Washington had informed Nvidia that its H20 chip will require a license to export to China, quote, for the indefinite future. This to do with concerns that it could be used in or diverted to a Chinese supercomputer. And remember, these H20 chips, Nvidia built some of the best GPU within the constraints of the existing restrictions from Washington for China. So Nvidia now expecting that these new requirements might lead to a $5.5 billion in charges in the fiscal first quarter, given the new restrictions, all at a time when Nvidia, of course, we heard was planning to produce up to $500 billion of AI gear in the U.S. So we continue to see all of the repercussions for these companies and countries despite their promises to do more within the United States, Heidi.
And really, Shery, kind of another indication that we're starting to see kind of the expanding scope and impact of this trade war, right? At the same time, you also have muting market sentiment at the moment. President Trump launching a critical minerals probe to weigh potentially new areas of tariffs. He's citing national security, resilience concerns. The probe to look into the impact of imports of critical minerals, including rare earth elements and uranium, when it comes to that security and resilience picture for America. And we know, of course, an upwards of 70% of the world's critical minerals and rare earth supplies actually comes from China. So that makes it a very interesting proposition there. We do have a couple of critical minerals and uranium players here in Australia as well, the likes of Pilbara Minerals off by about almost 3% there, and some impact, though, to the upside for Lynas Rare Earth. So potentially some opportunity there. We're also seeing downside in Rio Tinto after their exports fell to a 6-year low on account of those tropical cyclone impacts. More ahead on the Asia trade, this is Bloomberg.
I do have an additional statement that he just shared with me in the Oval Office. The ball is in China's court. China needs to make a deal with us. We don't have to make a deal with them. There's no difference between China and any other country except they are much larger. And China wants what we have, what every country wants what we have, the American consumer. Or to put it another way, they need our money.
White House Press Secretary Caroline Leavitt there reading out a statement from President Trump urging China to begin trade negotiations. For more, let's bring in News Desk editor Jill Deeses. It's interesting, in that statement saying that China needs to make a deal with the US. It doesn't seem like Beijing necessarily feels that way at the moment.
No, I mean, I think that the big takeaway here is that the U.S. and China haven't really pursued or gotten any high-level talks underway at this point. There's not really any indication that these two countries are coming any closer whatsoever on making a deal here. I mean, obviously, the past couple of weeks, all we saw was escalation after escalation after escalation in terms of the tariffs these two countries are putting on each other. In total, I think the tariff that the U.S. has put on China has reached somewhere around 145% if you account for some earlier duties. China's really not that far behind in terms of what they've imposed on American goods. And what we ultimately heard from China at the end of last week was that they were just going to ignore any future tariffs. You do have, obviously, a reporting from just yesterday talking about how, China's really urged its airline suppliers, it's halted, Boeing shipments coming in. So, I mean, you're really just seeing this really dramatic escalation in terms of how trade has been really impacted within these two countries. And there's just not a whole lot of indication that there's going to be any kind of, coming together in terms of how they pursue, anything at this point. It's really kind of just a game of chicken.
Especially when it comes to some critical components like rare earth minerals. We know that President Trump is now launching an investigation that could actually lead to tariffs. But I'm a little bit confused here because we have for a long time watched this sector as being very important for national security and how China really produces much of the world's critical minerals. But applying tariffs to them from the U.S. side, I mean, isn't it sort of shooting itself in the foot in a way?
I mean, I guess the logic here from the Trump administration's perspective is that, they're concerned about maybe an over-reliance in terms of where they get their critical minerals from. I mean, when you're talking about the kinds of minerals that are, incredibly important for national security, defense, types of manufacturing, that kind of thing. I mean, China is really home to producing some 70% or so of which, gets exported out, including to the United States. I mean, we're talking about a really, really significant, industry. This is also obviously, rare earths is also something that came up during Trump 1.0, during the first trade war. I mean, I think that China has known for quite a long time that they've got, kind of this really, really critical, this really, really critical industry, that's really heavily sort of concentrated within their borders and how important that is to other countries. I mean, again, this kind of comes down to a lot of these other tariffs that Trump is really pursuing here. We're seeing this strategy where, some of this ends up being, this idea of pursuing, what he's calling reciprocal tariffs on other countries, but he is also kind of drilling drilling down into those types of sectoral tariffs, including, potentially pursuing something on critical minerals, what he's already done on steel and aluminum and car parts and those kinds of things. But where that ultimately, sort of develops into a strategy for how exactly that impacts, U.S. national security, I think we're going to have to wait to see what the president ultimately decides and, how long it ultimately takes this Commerce Secretary investigation to come together. They've got 270 days, but this is also an administration that's indicated that they like moving on a much quicker timescale if they can.
Bloomberg Shield DC is there with the latest on the rising tensions between Beijing and Washington. And amid all of this, you have Chinese President Xi Jinping going around on a tour, strengthening relationships, now urging Malaysia to work with Beijing to protect supply chain stability. He's visiting the country on the second leg of his Southeast Asia tour. Bloomberg's Avril Hong is in Putrajaya. Avril, so what are we expecting from this visit?
Yeah, I mean, given how this is just an escalation that we're seeing in the trade war between the U.S. and China, showing no signs of de-escalation, I think the expectation is ultimately that China reiterates its commitments to Southeast Asian countries on this tour. I mean, don't forget, many of these nations have been beneficiaries, key ones in the China Plus One strategy. And I think it's no small coincidence that prior to the 90-day reprieve, the likes of Vietnam and Cambodia, which are the two other countries on the Southeast Asian tour for the Chinese president, were the ones that were slapped with the highest rates of tariffs by the U.S. So for the Chinese president, it's really going to be about trying to convince Southeast Asian leaders that, they should not at this point cut a deal with Beijing cut a deal with Washington at the expense of Beijing, I should say, and also to kind of promote itself, China, as more stable partner than the U.S. Now, for Malaysia, its significance is really prominent in this part of the world, in Southeast Asia, because it is ASEAN chair this year, and it has been advocating a coordinated response by the 10-member grouping, but it also itself walks a very fine balancing act. China is its largest trading partner. On top of that, it is engaging in these negotiations with the U.S. What we are expecting later today is potentially these MOUs being exchanged by the two sides, remarks as well from both the Chinese leader Xi Jinping as well as the Prime Minister of Malaysia, Anwar Ibrahim. I'm standing just outside the Sri Perdana complex, which houses the official residence of the Prime Minister, where the two are set to meet. Currently, the Chinese president is said to be at the National Palace, engaging in a state welcome. So those are the things that we are expecting out of this visit.
What sectors are in focus for this visit, Avril?
Yeah, given the deepening rift between the U.S. and China and how we've seen rare earths really becoming a tool in this trade war, I think that as commodities is one that we're keeping a really close watch on, because you know how China has been halting exports. The U.S. has also been announcing these probes into critical minerals. Don't forget, Malaysia has a lot of rare earths. Outside of China, it actually houses the largest processing plant for rare earths in the world, but it is still really reliant on the likes of China for technology. Now, it's also, I think, really telling that in state media, the Chinese president sort of highlighted the green economies, and this is coming at a time where China is trying to enhance its tech supremacy. So we have seen, indeed, these Chinese tech giants investing into Malaysia in terms of data centers. By some estimates, we have tens of thousands of Chinese firms that are actually using Malaysia data centers. So anything between the two leaders that suggests that investments in these sectors are intact or indeed going to be enhanced, these would be encouraging signals that we're keeping an eye on.
Bloomberg's Avril Hong there. More ahead on China later this hour. Oxford Economics joining us to talk about the trade war's impact on Chinese growth. We're awaiting those first quarter GDP numbers, but in a sense, we're really looking ahead to future data points to show the impact of the trade war on the Chinese economy. More ahead on the Asia trade. This is Bloomberg.
Goldman Sachs chief U.S. equity strategist David Kostin says that investors are pricing U.S. growth of around 1 to 1.5% this year, despite the escalating trade risks. But he told us that the uncertainty over tariff policies is already affecting trading volumes.
Well, certainly there's a high degree of uncertainty. Largely that's around the policy of the exact nature of the tariff and the likelihood or not whether there'll be a recession. And our economists here ascribe around a 45% probability of recession in the next 12 months. So the base case is, in fact, not a recession. The economy continues to grow. And so, Matt, the way we think about it is from a market pricing perspective. The equity market is pricing as though the economy is going to grow around 1.5%. That's right now. We make that conclusion based on looking at the relative performance of cyclical stocks, long, short, defensive stocks. Cyclicals versus defensives, that's correlated or scored relative to the GDP growth environment. And that would suggest the economy, the equity market right now is pricing as though the economy is growing 1.5%. That's a little bit above where the Goldman Sachs economists think the baseline growth is. And it certainly is not pricing in the risk of recession. And so all of the conversations we have, of which we have many each day with CEOs and chief financial officers of different companies, are about how do they signal the guidance? Should they be withdrawing guidance for the quarter, for the year? Should they widen the range? How does one think about giving guidance to the investor community? So there's a lot of uncertainty for obvious reasons, and that's reflected, I think, in the performance of the market right now, which is stabilizing these levels.
Well, David, I want to talk about how technical factors such as liquidity factor in, because actually the Goldman Sachs Prime Desk said last week on Wednesday, top of book liquidity on the S&P 500 futures was near all-time lows heading into the crash up that you saw on Wednesday. I know that you recently said in a note that liquidity has deteriorated pretty sharply over the last couple weeks. And when you think about the sort of negative feedback loop that creates with volatility, what actually breaks the cycle? What brings more liquidity into the market?
Well, the reason for there's several reasons for low liquidity, one of which is the uncertainty around what's taking place. And one of the consequences of a less liquid market is more volatility in either direction. Doesn't take necessarily dramatic changes in sentiment to have price action that's pretty dramatic. And you saw that, of course, last week.
Goldman Sachs chief U.S. equity strategist David Kostin there speaking with Bloomberg's Katie Greyfield. Taking a look at how futures in Europe are opening up at the moment after what was a pretty solid session previously. We saw that rally in banks, a bit of a miss when it comes to LVMH and the broader luxury sector, which is seen as really kind of a litmus test on the consumer and how that's going to be affected by tariffs. We are seeing downside there for Euro Stoxx 50 futures, DAX futures off by about 0.4% as well, really reflecting the fact that we're seeing Asian stocks edging lower. US futures, they're also sliding. This potential broadening of the tariff and broader trade conflict. Nvidia is one part of that story, saying that the US put new restrictions on some chip exports to China at cost to Nvidia. We're seeing chip makers and tech stocks, as well as that expansion into a probe into tariffs on critical mineral exports as well. More ahead on the Asia trade. This is Bloomberg. Take a look at what we're watching in Australia as we see sort of broad downside as these fears that the widening of Trump's tariff war continues to build, particularly when it comes to what we saw with Nvidia overnight with that China-related charge, as well as now the expansion into a probe into critical minerals and how they can potentially be tariffed as well. We're seeing downside actually pretty flat when it comes to Australia, keeping in mind there's a fair number of miners, gold miners, and also a few rare earths and critical minerals miners here in Australia as well. So we are seeing a little bit of selective upside on that news flow, potentially some opportunity seen there. The Aussie dollar on the back foot after we saw a little bit of a recovery in risk for both the Aussie and the Kiwi, but still well above the levels that we saw in the depths of the equity market sell-off there as well. Also quite a bit of calm being restored to sovereign bonds trading at the moment and treasuries. We are just getting some news crossing the Bloomberg. The March Westpac leading index falling by 0.11% month on month. These readings becoming a little bit bit more critical as we get, of course, closer to the election, of course, really monitoring the impact of tariffs as well as secondary weakness out of China on the Australian economy. I should point out Morgan Stanley has also upgraded its Australian stocks view to equal weight. Well, when it comes to China, UBS is the latest big bank to downgrade its China economic growth forecast. Its analysts see just 3.4% expansion this year due to the impact of US tariffs affecting exports. UBS forecasting 3% growth next year, expecting exports to fall by 2/3 in coming quarters. The bank anticipating that the Chinese government will add fiscal stimulus worth up to 2 percentage points of GDP to bolster growth. Our next guest says that any loss in China's growth momentum will spark political appetite for immediate fiscal support. Betty Wang is a lead economist for Northeast Asia at Oxford Economics. Betty, always great to have you with us. So how quickly do you see this fiscal push being implemented? Because at the same time, we're not really seeing signs of Beijing wanting to compromise or to step down.
Yes. Hi, good morning, Heidi. Well, I think in terms of the fiscal stimulus, there are actually some implementations late last year regarding, to stimulate the consumers' consumptions, as we can see that the so-called consumer goods trade-in program, and it got extended to this year by covering more consumer goods for consumers to spend. So I think on that front, the fiscal stimulus kind of execution has already started. But I think what market has expected following the April 2nd tariff announcement from the U.S. might not have started just yet. But we do think that, given the all kinds of situations that happened recently, there will be a strong incentive for Chinese government to embark on more fiscal stimulus in the following months, if not quarters, and particularly the Politburo meeting, which will likely be held by the end of this month, will announce some, measures or to picture the future policy directions.
One of the quickest and easiest ways to get growth up again is through infrastructure and broader fixed asset investment, right? But of course, in the past, we've seen diminishing productivity returns. Is this a risk in this round of stimulus?
Well, I think if you look at China's historical experience, of course, relying on so-called the traditional measures such as infrastructure investment would be quite handy and efficient in terms of driving growth as well as creating job opportunities. And in fact, we don't exclude the possibility, for policymakers to rely back on these measures to secure at least a near-term growth momentum. But as you said, how to address the decline in productivities as well as the long-term labor shortage kind of things that would require a massive investment, as well as in the high-tech sectors, for example, AI and all those related sectors that could help to offset the structural weakness in Chinese economy. And on the other hand, I would like to stress the importance of private sector. And we all know that, private sector plays such an important role in supporting not only China's tax revenues, but also to create jobs. So I think that's very important in the current situation when, the job market's uncertainty will likely rise because of this tariff shock. So how to support private companies, that will be very important as well.
Yeah, very important to really keep the Chinese public happy as well, right? So what is the threshold of economic pain that President Xi Jinping can endure before coming to the negotiating table with Trump, and how close are we to that?
I think is a calculus from both sides in terms of whether they can come back to the negotiation table. Of course, I think from China's perspective, or from President Xi Jinping's perspective, he doesn't need to worry about kind of public opinion that much as the U.S. President Trump. And at the same time, I think China has made it very clear that they want to focus focus on their domestic economy right now by implementing more domestic policies. So I think that the bars for the to come back to the table looks relatively high at the current moment. But of course, in the future, especially those multilateral meetings or events, there will still be a chance for those two parties to come back to the table. And indeed, if you look at Chinese official statements, especially in the 9th of April, that was just before the onset of the U.S. Tariffs going into the 3 digits. So there was a white paper released by the State Council. I think if you read through that statement, it still suggests that China is willing to come back to the negotiation table, but it's going to be a kind of bilateral recognition of both sides' interests.
Of course, we do have some backwards-looking first-quarter GDP numbers out of China today, not to mention the March activity data. What sort of economic health picture are we expecting from Beijing?
Well, I think as in terms of Q1 growth, our current forecast is a 5% on a year-to-year basis, and I think the number could come out to the upside. So as we can see from the first quarter, actually China's exports, services sectors were relatively doing fairly okay, to be honest. But just as you said, it might become irrelevant because of this tariff thing, and we do think that the weakness in the economy after the tariff shock is likely to be reflected in hard data from Q2 onwards.
Betty Wang, good to have you with us, lead economist for Northeast Asia at Oxford Economics. Now, President Trump calling on China to reach out to him for talks aimed at resolving the escalating trade fight. But a former top Chinese official says Beijing will only engage in talks with Washington if U.S. leaders show some respect. Former Chinese Vice Minister of Finance Zhu Guangyao spoke exclusively with Bloomberg on President Xi's 3 main principles for dealing with Washington.
I think for this specific negotiation should be based on real instruction by 2 presidents. President Xi highly emphasized the relation with the United States. President Xi always emphasized based on 3 principles: mutual respect, coexist, and win-win situation to develop a healthy, stable, and sustainable relationship with the United States. That's China's policy. That's President Xi gave clear instruction to all level of Chinese staffs. That's based on that. I was before to deal with U.S. in economic. We fully respect the U.S. We fully follow the instruction by President Xi Jinping. We do everything, maintain the healthy, stable, and sustainable relation with the U.S. But this time, again, we must take action, retaliate, because we don't want the whole world return to the jungle of jungle law.
So just to be clear, right now, the 2 sides are not on speaking terms. Officials on 2 sides are not discussing possible solutions to the trade war. Is that correct?
That's subject to how do you define that. If that's U.S. want China totally accept the U.S. proposal, to accept U.S. conditionality, I think that's no negotiation. And must be under the mutual respect and with this joint win-win situation.
What does mutual respect look like? Would the U.S. have to reduce the tariffs to 85%, 60% to bring President Xi Jinping to negotiations?
I know in U.S. team always think the President Trump is the top negotiators. Art of Deal, the book written by President Trump, and let's do business. Now it's country-to-country relations. We should exactly follow the rule of WTO to deal with bilateral trade dispute rather than to use the just pressure. Since People's Republic of China founded, China never yield to outside pressure. So that's why I hope real negotiation for trade imbalance issue should be based on mutual respect, not just used as pressure and let the other side accept all conditionality raised by U.S. That's impossible.
China's former Deputy Finance Minister Zhu Guangyao there speaking exclusively with our Inside anchor Haslinda Amin. Some of the other political headlines that we're following today, and Singapore's government has called for a general election on May 3rd. The vote will be a referendum on Prime Minister Lawrence Wang's leadership and the ruling People's Action Party's approach to navigating choppy geopolitics. High living costs are also top of mind for voters, with the government, announcing plans to spend nearly $100 billion of this year to ease economic pain. Republicans in the White House and Congress are mulling how to craft a new tax bracket for rich Americans. Bloomberg has learned that a House proposal would set the new rate at 40% for taxpayers earning over $1 million a year. The discussions of a tax hike come as Republicans look for ways to pay for a tax cut package approved last week by Congress. President Trump has escalated his administration's fight with Harvard University by threatening to revoke its tax-exempt status. That's after the school defied demands to change its policies in exchange for billions of dollars of federal funding. Stripping Harvard's tax-exempt status would deal a significant financial blow, removing benefits such as selling tax-free bonds. More ahead on the Asia trade, this is Bloomberg.
Take a look at how automakers are trading across the Asia session. Of course, we have seen President Trump now imposing that 25% tariff on fully built vehicles. We are awaiting those duties on parts to also take effect as early as May 3rd. But at the same time, we had heard President Trump floating the idea of a temporary reprieve for these automakers. So we'll continue to watch what the implications will be for these Asian car makers. We heard from one Hyundai Motors top executive now expecting car prices to remain relatively steady over the coming months, despite added costs from the global trade war. President and CEO José Muñoz told us exclusively that the best way for the car maker to respond is by stepping up U.S. production.
In the case of Hyundai Motor Company, we produce in the U.S. We don't produce in Mexico, really maybe very minor, but we took a conscious decision to invest here in the USA. The rest of the production comes mainly from South Korea. Well, we are part of the Alliance for Automotive Innovation. John Bosella, the president, is representing the industry and is conveying to the government the needs that we have in the industry, which are pretty much common across the board. And then we know that there are some discussions between the South Korean government and the White House. We are not actively part of that discussion, and then obviously I cannot reveal what they talk about. But definitely we all want to ensure that there is a plain level field for everybody, so that we can compete in good terms in the market, and we want to be competitive. I maintain this message for the consumer. We will be competitive, and then the market will decide, depending on the supply and demand, if there's going to be some price increase or not. But again, we need to be competitive.
Right. So that's what I was wondering. I mean, what does competitive mean? Does that mean you're eating the costs to keep your market share, keeping your costs that consumers pay, car buyers pay, and willing to take the hit? Or, how does that dynamic work?
That dynamic is not different to the way it's been done over the last 30 years or so. It's just simply, in the short term, an additional burden to manage, given all the implications of the supply. Again, our job is to focus on what we can control. The cost is something we can control. How are we responding to the increase in tariffs? Localizing, investing more in the country so that we don't get to be hit by by tariffs. That's a simple solution. And then on the revenue side, we'll have to see how the market reacts. If we have the opportunity to take maybe some reduced incentives, increase price here or there, we will do. But you're not going to see like a huge increase all of a sudden, or we are not planning to remove cars from the portfolio simply because of the tariffs, etc. Again, the most important is a good product, safe product, good quality, good features, and be competitive in the market. And then the rest is our job to try to optimize through localization.
Hyundai Motor CEO José Muñoz there speaking to Bloomberg's Katie Greyfeld. Well, South Korea's volatile small cap stocks have emerged as unexpected winners of the tariff turmoil. Some analysts see these gains as being extended thanks to strong interest from retail investors. Our Asia Stocks reporter Yu Kyung Lee joins us now. So why are we seeing these gains in the Kosdaq amid the ongoing tariff chaos and broader market volatility?
Sure. So this might be a surprise to a lot of people because if you think about South Korea, it's a very heavily export-dependent nation, and yet the small cap Kosdaq index is one of the best performing gauge in Asia, equity gauges, and it's pretty much the only one that's seeing month-to-date gain, up about 5% so far this month. And one reason is because the Kosdaq has been already cheap before the tariff hit on April 2nd, and the level got even cheaper after the sell-off. And another really important reason is that we're seeing signs that the retail investors of South Korea is making a comeback. They've been buying Kosdaq almost every month since January after heavily selling them in December. And so their comeback, there's several reasons for the comeback of the retail investor. One is that some of the most popular global assets to retail investor have been seeing a correction, such as the Bitcoin, the Nasdaq 100 index, and some of the Magnificent Seven, the U.S. mega cap textiles, those that are hugely popular among Korean retail investors, have been seeing sharp corrections lately, and that has been so the South Korean retail investor has been suffering from the losses, and yet with the gains in the local market, a lot of these profit has been drawing this retail investor back to the domestic equities, and that's what has been driving the Kosdaq's gain this month.
So for these retail investors, are there any sectors in particular that are appealing, especially if they're seen as a little bit safer from these tariff noise?
Sure. South Korea has a pretty diversified business sectors, and one of them being cosmetics and beauty devices that analysts have been saying that could be relatively safe from global tariff war. And that is because South Korean cosmetics are known for being really cheap and giving a good value to consumers. So even though some of those lipsticks or cushion becomes a little bit more expensive, it's still affordable. So people see less of a tariff impact on the cosmetic sector, and that are one of the sectors that we have been seeing gains. And the other one is entertainment and K-pop. You can't really impose tariff on the K-pop songs. So these K-pop agency has been staging some rallies. And another last one to watch is some of the sectors that are expected to benefit from the presidential election campaigns. With the elections coming up in early June, a lot of investors have been chasing the winners, potential winners from the upcoming presidential elections, such as artificial intelligence. And these are still really, really volatile, but has been giving those volatility has been really appealing to retail investors who love risk and volatility.
Bloomberg Asia Stocks reporter Yu Kyung Lee, of course, as we focus on some of those gamblers when it comes to the markets. But really, that volatility being felt in the semiconductor space right now, right? Because we continue to hear more news around tariffs, around export restrictions. And you can see SK Hynix, a big supplier for Nvidia now, leading some of those losses. They're down about 3%. Washington informing Nvidia that its H20 chips will require a license to export to China. We have already heard of potential negative impacts coming from that probe on semiconductors, on national security issues that President Trump has already ordered. Invesco is now saying that Nvidia curbs will have a significant negative impact, and the strongest effects are actually anticipated for TSMC, so do watch that stock when the Taiwanese market opens as well. We have more ahead on the Asia Trade. This is Bloomberg.
The latest from the corporate front now, and Nvidia shares fell sharply in extended trading after it revealed it's facing fresh US export restrictions to China. The chip giant says the US government will begin requiring a license to export the company's H2O chips. Nvidia now sees a first quarter charge of $5.5 billion tied to the product. The H20 is a scaled down chip designed to meet the previous US restrictions on shipments to China. Creditors of Xinyuan Real Estate are seeking to force the company into bankruptcy protection in New York. According to a court filing, the Chinese developer failed to pay off a bond that was due late last year. Creditors say the company has assets in the US that could help to be used to repay the $66 million that they're owed. Rio Tinto says first quarter iron ore shipments fell to a 6-year low after tropical cyclones disrupted exports from its key Australian terminal. The world's second largest miner shipped over 70 million tonnes of the steelmaking material, marking a 9% decrease from the year before. Meanwhile, top iron ore supplier Vale also reported lower first quarter output amid heavy rainfall in northern Brazil. The company churned out 67 million tonnes of iron ore, that was about 5 million short of estimates. And we are watching the impact when it comes to the miners, both in terms of the iron ore miners, also some of the gold producers in focus as we get another record high for the precious metal amidst this ongoing haven demand that has returned. But critically, pardon the pun, critical minerals are actually in focus today, given that Australia does have at least about a 4% supply of global critical minerals. And Shery, we know that this could be kind of the new front in the trade war. President Trump and the administration saying that they're undertaking a probe into what tariffs could be applied for critical minerals to sort of better support security and resilience in the US. The question is, of course, where that supply is going to come from, given that we know that over 70% is actually in China. You can see mostly downside, but Lynas is the one upside there in terms of one of those Australian producers.
A probe also on semiconductor imports coming from the U.S., right? And on top of that, we have Washington now informing Nvidia that its H20 chips will require a license to export to China that could cost it billions of dollars. And Invesco now saying that one of those stocks that you should be watching is TSMC, given that we'll see the most effects on them and also semiconductor component manufacturers across Asia. That's it from the Asia trade. The China market opens are next. This is Bloomberg.